What's going on, everybody, and welcome to the video. In this one, we're going to be talking about 3 different dividend stocks that I believe have a lot of upside potential. Now, just a little disclaimer is I do not own any of these 3 dividend stocks, and you might be sitting there like, well, why would you even talk about dividend stocks that you don't own? And that's because I really only own like 20 stocks in my dividend portfolio, and that would limit me to only talking about 20 stocks over and over again. And just because I don't invest in a stock doesn't mean I think it's a bad company. So let's go ahead and get into these 3 dividend stocks. But before I go any further, always, if you enjoy this type of content, you subscribe, yada yada. Not going to waste your time on that. Let's get into it. So first up, the first stock we're going to be looking at is ticker BIPC, Brookfield Infrastructure Corporation. They currently trade for about $66 a share. And over the past year, they are only up 0.94%. Now, they had made some big run-ups all the way to $80 per share. And ever since July, they have just been downtrending. Now, this is kind of an oil and energy company, and they've only been on the market since the beginning of 2020, like right when COVID happened. And they've been uptrending ever since then. Now, let's go ahead and talk about their dividends. Their dividend yield, it's kind of a newer company per se, and so they've only had a dividend growth for 1 year. However, management is expecting to increase this dividend consistently every year from anywhere from 5 to 9%, which is really solid. And looking at their current dividend yield of 3%, that's a really good payout that you could be receiving with these dividends. Now, they do pay their dividends on a quarterly basis. If you buy in now, you should be getting in on their next announced payment, which will probably be in March of 2022. So it'll be about 2 months from now. Let's go ahead and talk about some more stuff on this company. Looking on some key statistics about this. Now, some key concerns did kind of strike my mind whenever I saw, wow, profit margin of negative 12%. So I did some digging. We'll look into that in a little bit. But they have really good EBITDA of $1.28 billion from $1.6 billion in total revenue. Revenue growth year over year is looking pretty solid. Total debt to cash, not the best, but their free cash flow is insane. $1.99 billion in free cash flow. Let's go ahead and talk about who this company is. Brookfield Infrastructure Corporation, together with its subsidiaries, owns and operates regulated natural gas transmission systems in Brazil. They also engage in regulated gas and electricity distributions in the UK. They operate approximately 2,000 kilometers of natural gas transportation pipelines in a bunch of different countries and 3.6 million gas and electricity connections. So they own a ton of gas pipelines and a ton of natural gas operation systems just worldwide, giving them a lot of upside potential. Now, if we go ahead and look onto these different things, I saw profit margin decrease. So let's go ahead and talk about that. This is their most recent financial statements. So from 2021, for the 3 months ended of the Q3 of 2021, they made a net income of $213 million. This is in US millions. And then for the 9-month period, they made a net income of $192 million. So they made a massive comeback in the past quarters, you can tell. And I really like to see that. They were probably just struggling for the past year for a number of reasons. I believe it was in Q2 of 2021 that they announced this, and that is why they had that massive come down. But since they announced, hey, we have good earnings for Q3, they've started to make that uptrend. And if they can consistently bring that on, that is going to be really good sentiment for the stock. Now, looking on their cash flow, like I said, really solid stuff. 2019, 2020, 2021. It's been uptrending since 2020. They had a really good 2019 and even a 2018. It's been falling, but it's still in the positive numbers, which is really good stuff. Morningstar analysis gives BIPC at a 9% discount. So they're saying this dividend stock is trading below its fair value of $73 a share, which is pretty solid stuff, especially this company being a new company. Giving them at a 9% discount, I really like to see that. The institutional activity, a lot of inflow compared to outflow, $787 million in inflow compared to $370 million in outflow. Always good stuff to see more people buying and selling. Now, analyst price target, there's one price target on this company right now for $70 a share, giving it an overall thesis of a strong buy. Now, let's go ahead and talk about stock number 2, which a lot of you guys love, which is ticker STAG, Stag Industrial. This REIT, a lot of upside potential, but we'll talk about what I believe about this company and why I'm not invested into it. So first off, let's start with the past 6 months. They're up 10%. In the past year, they're up 43%, which is really good returns. In the past month, they are down 3.3%. They have a dividend yield of 3.35% and a market cap of $7.75 billion. Looking at their dividends, they have some pretty solid dividend grades. They have a payout ratio of about 71% on Seeking Alpha, a dividend growth streak of 7 years, and a 5-year growth rate of 0.85%. Now, that is my main reason why I'm not invested in this company, and it's not because I hate Stag. Like, there's not necessarily any stocks out there that I'm sitting there and like bashing on completely. I wouldn't be making a video kind of saying, hey, these are good stocks to buy if I hated them. It's just for my investment style, my investment time horizons, I'm aiming for more growth. And I want my dividends to be growing and get my yield on cost a lot better. And even though Stag is growing at incredible rates, 41%, I think that is slightly offset by a number of reasons, kind of like COVID, because usually it's not growing that fast. And it's just been incredibly outpacing for the past year. Let's go ahead and talk about some other things. They have incredible profit margins, 37% on their profit margin. Quarterly revenue and earnings growth, really, really solid. And levered free cash flow, $130 million. Really like to see that. Now, the payout ratio on Yahoo Finance says it's roughly 114%. But whenever I saw that, I had to do some digging in myself. And so I went ahead and saw their dividends and distributions payable for September 30th of 2021. That quarter was just $20.9 million. So then I was like, well, let's go ahead and see what is their total net income. Well, their net income was $49.5 million. And for the 9 months, it's $108 million. So that's really solid stuff to see. Their payout ratio is very, very good. Incredible stuff. Now, taxes and different things like that, it comes into different play because REITs are required to pay 90% of their taxable income to shareholders via dividends. But still, it gives us that sentiment that this is a very sustainable dividend and that they're not just taking on incredible bad things for them to pay this. Now, giving you a visual aspect, their revenues are increasing incredibly. Net income increasing, except for a 2018-2019 little dip. Now, the company's portfolio is really solid, an enterprise value of $8.7 billion, 517 buildings, 40 different states, 103.4 square million, which is square feet in millions. That's a lot of square feet if you ask me. Looking on some more things, this is another reason why I'm kind of not invested in this company, is just looking at their analyst expectations for their earnings. They're expected to drop by 15 cents per share, but sales are expected to grow. So pretty solid stuff on that. Now let's go ahead and talk about this. Stag is trading at a 9% premium. Another kind of reason why I'm like, is this a good investment that I want to put in my portfolio to give me 100% conviction? But they have a fair value of roughly $39.86. For Morningstar, this does not give them 100% fair value, but their last close at $43.59. Looking at institutional activity, a lot more inflow than outflow. Really good things to see. Now, let's go ahead and talk about stock number 3 on this list, which is going to be Target Corporation, ticker TGT. They currently trade for $220 a share. They have a dividend yield of just 1.63% and a 1-year growth rate of 11.8%. Now, they've been downtrending for a little bit, and I want to say it's mainly due to Omicron concerns and different things like that, because as these concerns come into our economy and just different aspects of things like that and inflation, people are kind of hating on these companies raising prices, especially a company like Target whose prices are super high compared to other grocery stores. It leads them to have good margins, but with inflation mixed, it might strike some concerns on people being like, when they catch on to, hey, inflation's really high, should I go pay even more money at an expensive grocery store, or should I try and conserve my money and pay at a cheaper grocery store, something like Walmart, something like that? And it does kind of strike these concerns. You have to think the business model. But looking on some more stuff on this company, they have a really solid payout ratio of just 27%, a 5-year growth rate of 6.38%, and a dividend growth record of 53 years. Now, they recently declared their dividend. If you want to get in before November 15th, February 15th, sorry about the complete stutter right there. If you want to get in before February 15th, you will get that dividend paid out on March 10th. Looking on some more things, they have a quarterly earnings growth of 46% and revenue growth of 13%. Free cash flow is really solid, and Yahoo Finance says they have a payout ratio of 21.6%. Profit margins, these are really, really solid, especially whenever you go ahead and you compare them to other companies. Like if we went to go look at Walmart's, I'm going to go ahead and actually look at Walmart. So we saw Target right here is a 6.5 payout ratio, or not payout ratio, profit margin. Sorry, my brain's going all over the place right now. Let's go ahead and look at Walmart statistics. Once it loads, they have a profit margin of just 1.4%. So Target, because they have these high prices, can make big profits. Now, looking on to some more stuff, their revenues increasing year over year, really solid. Net income increasing year over year, really good stuff to see. Now, the analyst expectations, earnings are growing just slightly by 10 cents a share, but that's it when you're at 13 per share, so it's really not a big increase at all. Their sales increase are going up, but they should be going up a little bit more, especially with inflation and how much Target can price things now. But looking at a different company like Walmart, their sales aren't expected to grow incredibly well either, so they're about the same competitive rates. Target right now is trading at a pretty high premium compared to their fair value of $169, which is my main thesis on, is this an overvalued company? And it says they have no economic moat, and it's because of the competitive business that they're in. You know, you got other companies like Kroger, Costco, Walmart, name it, and they're trying to sell groceries. Now, institutional activity, outflow is $8.24 billion and inflow is $11.81 billion, so more inflow than outflow. These are three dividend stocks that I think have some upside potential if you want to go look deeper into them. I'd love to hear you guys' input, so leave a comment below. Make sure to subscribe to the channel. This is my other channel. Just go check it out if you want to. It's called Investing Alpha. More about growth stocks if you're interested in that and different things like that. More educational and more just growth stock, kind of riskier investments. But thank you again. Thank you for making it to the end of the video. If you enjoyed it, subscribe, all that good stuff. But if you want to use M1 Finance, make sure you use that link in the description below. You can check out my portfolio, go look at it, all that good stuff. And you can also use M1 Finance, sign up, deposit $100, and then you can get $50 back, which is insane money. That's a 50% ROI. So make sure to check that out. Again, thank you, yada, yada, not going to waste your time. And I will see you at the next video.